Good morning and good afternoon, ladies and gentlemen. Thank you for joining us today for our Applying Deep Learning to Predict M&A webinar. Before we begin, just want to cover a few housekeeping items. We will be recording today's session, and the on-demand version of this webcast will be sent to you in the coming days via email. And if you'd like to log in a couple of hours' time, you can use the same URL as you've just used to log in. At the bottom of your screen are a few widgets that you can use. All of them are resizable and movable, so you can make the most out of your screen space. If you have any questions, please submit them through the Q&A widget. We will try and answer all questions during today's session, but if we do run out of time, we will follow up with you by email. And please do note that we record all questions. We'll be using interactive polling shortly and would like to encourage you to participate. There are additional resources for you in the resources list, so please download those that you might find useful. And if you'd like to know more about our speakers today, there's the speaker bio widget. For the best viewing experience, we recommend that you close any programs or browser sessions you might have running in the background. This will help you conserve your bandwidth. And the webcast is being streamed through your computer, so for the best audio quality, please make sure your computer speakers or your headset volume is turned up. Some networks cause the slides to advance more slowly than others, so if you are on a VPN network, we recommend that you switch that off or come off that. And if your slides are not progressing, please push F5 on your keyboard or Command R on a Mac to refresh your browser page. We value your feedback, so would appreciate if you could complete the pop-up survey at the end of this webcast. Right, so to kick off today, this is the first of our 2 polling questions. If you would please submit your question, indicate what your job title, job role would be. We'll give it a few seconds for everyone to submit their answer. This is to help our speakers understand what our live audience is made up of, or who it's made up of, rather. Okay, we'll just give it another second or two. Okay, so as you can see, we've got a nice mix of attendees today. Thank you for doing that submission. And then moving on quickly to our second polling question. Are you currently using a quant M&A prediction model? If you can submit your answer, either yes or no. Give it a couple of seconds for everyone to submit. Okay, I think we can move on. Wow, it's an incredible number. So 100% of you are not currently using an M&A prediction model. So thank you for that. Great, so I'm honored to introduce our moderator for today, our Global Head of Market Development for Quantitative Analytics, Richard Goldman. Over to you, Richard.
Thank you, Renee. And good morning, good afternoon, and good evening, everybody. Thank you for joining us today. Data scientists and quantitative investors utilize a tremendous amount of data in training and testing their models. And managing the data presents significant challenges that, if they're not properly addressed, will impact their model's effectiveness. First amongst these challenges is corporate actions. Companies are continuously merging, divesting, selling off and buying assets, or delisting through bankruptcies. Here's an example from way back when AT&T was the only phone company in the US, and all of the subsequent divestitures, starting with when it was forced to split up into the baby bells, and then subsequently all the corporate actions that have occurred through all these baby bells. This is just one company. And if you're dealing with a global universe of tens of thousands of companies, you can imagine the amount of corporate actions. All of these have to be accounted for on a point-in-time basis to ensure that historical data is accurately reflecting the reality that existed at that point in time. Mapping identifiers. Many different databases use different identifiers to a specific company. Some databases use tickers, or RICs, which is from a Reuters database, or perm IDs, which is a Refinitiv identifier, or QSIPs, or CEDALs or ISINs. These are all well-used identifiers, but if you have databases using different identifiers, you need to map these to each other, and not just today, but historically, because they constantly change. Survivor bias. Survivor bias refers to the removal of companies which no longer exist. If you looked at today's universe of companies and go back in time, it doesn't consist of any companies that have delisted. Here's an example of the largest companies in Asia 10 years ago. And what you can see is that several of them have subsequently delisted. So if we went today and took the largest database today and said, what are the largest companies 10 years ago by looking at their market cap 10 years ago, you would not have included these companies because they would not be in today's database. That's survivor bias. You need to retain all companies that have been delisted, bankrupt, sold, or merged into other companies. Look-ahead bias. Look-ahead bias pertains to using information that did not exist at a particular point in time. It's like looking at a newspaper. You want to make sure that if you go back to a specific date, that you're only using the information that was available at that point in time. In this example, we're looking at the revenues for Yum. Yum Brands is the restaurant chain that owns all of the KFCs, Pizza Huts, and Taco Bells around the world. And you could see that back in time, in 2013 and 2014, they first reported their results, and then subsequently in 2013, it didn't change at all. But in 2014, it changed. 3 years later, they revised their number to account for very specific accounting requirements. So if you were to look today on some databases, you'll see these numbers if it's not a point-in-time database. But for 2014 and 2015, those are not the numbers that were known at those specific dates. So a point-in-time database would retain all of those old values and the dates at which they were known. This again ensures that you're using a proper database for training and building models. A constant challenge of investors is finding data that adds alpha. It's becoming increasingly difficult to outperform the markets using the traditional databases, and investors are continuously looking for new sources of data or ways to improve it. And then there's the ongoing challenge of how do I manage these huge amounts of data? How do I concord them across different databases and map them over time? How do I ensure that they're normalized? So if I'm comparing companies from different countries, I'm not using different frequencies or different currencies. Or if they're time-stamped, I'm looking at the right time and date, even if it's a particularly different time zone. And then increasingly, as analysts are looking at new types of data called unstructured data or alternative data, they're finding that there's lots of challenges with this alternative data. Often the data quality is poor. The universe is too narrow to be used for many use cases. It pertains to maybe one sector or one industry. And some of this data is really interesting when you're looking at satellite data to keep track of the number of cars in front of stores. That's interesting. It can provide real insight, but it only pertains to a few hundred retailers and isn't useful if you're looking at a universe of 10,000 companies. Often this data doesn't have enough historical data to actually test it over cycles. And it's often very difficult to integrate with the current data that's being used. And in many cases, the legal permission for using the data for the purpose at hand is somewhat vague. Our clients have found that unstructured text is the most fertile of alternative data sources. And this is an area that Refinitiv in the short term has really focused a lot of effort. Over the last 15 to 20 years, we've been building our unstructured text offering because investors find that it has the broadest coverage. It pertains to every company, currency, commodity. If you think about news or research or filings and transcripts from conference calls, every company is covered. The data tends to be high quality. It's collected by reputable sources. It's always point in time. I shouldn't say always. It's often point in time, both historically and live. And the legal permissions are quite explicit. Due to the improvements in technologies over the last 10 years in computing power, which has enabled models for neural networks and things like that to occur, the advancement in natural language processing to take real-time text feeds and understand it and create various models from it, and the vast library of open source code has really enabled unstructured text to be more accessible to a wider audience. And this wider audience is using it for a wide range of use cases. Quants traditionally are searching to improve alpha, and they were the first ones to take advantage of unstructured text. But we're seeing, as will be discussed later by our data scientists, that it's often used for event detection, whether it's credit default or predicting M&A activity or identifying potential vendor risk or customer risks. Scientists have found that text can often be useful for predicting volumes and volatilities in various markets and detecting risks and market paradigm shifts. And often we're seeing use cases where the unstructured text and the analytics behind it are augmenting fundamental workflows for traditional portfolio managers to more efficiently access news, research, and other sources. At Refinitiv, we have a wider range of unstructured text. Starting with real-time news, we have exclusive access to the Reuters News Service, which is a truly global organization with a reputation of unbiased and many news-breaking stories. Its coverage of 41,000 companies and its history to 1996 is unmatched. We also have a common feed of all the research from brokers, ensuring that there's a consistency across the feeds, regardless of language, in terms of the metadata, the schema, the sector breakouts, and all that thing. So a user can cut across multiple brokers with common terminology. We have transcripts and briefs from conference calls, speeches, and presentations by companies, and all of the filings from annual reports, press releases, legal actions, et cetera, across 244 countries in 46 different languages. All of these real-time text feeds are being used by data scientists to both train their models and test them. One set of data scientists is actually one of our partners, MarketPsych, which has created a really interesting set of sentiment indices. This is a unique set of indices which uses both news and social media to determine thematic indices and their readings. So some of these indices are common across all the asset classes. For example, sentiment and general optimism. And it's important to understand the difference, because a lot of times when people see these common shared fields like anger or surprise, they don't quite understand how that could be useful. But research has shown that when, for a particular company or commodity or currency, when there's extreme levels of, say, fear, that volumes tend to go down. But when there's extreme volumes of anger, selling pressures tend to increase. And what the data scientists at MarketPsych realized is that there are asset-specific indices. So when it comes to things like commodities, understanding the weather damage from storms, if there's a particular news articles or social media posts that refer to weather damage of crops, that indice will start to be positive and negative. And when it comes to companies, there are a lot of really interesting indices ranging from labor disputes to long-short position to litigation, merger risk. So all of these indices allow data scientists to have more specificity when they look at creating various types of models. And you can see within countries, there's an indice for human infectious disease, which obviously is pertinent in the last year. Refinitiv has a wide range of traditional data that is used by both quants and data scientists around the world. This ranges from company-specific news and commentary to financial information and market information to the largest economic database in the world, to reference data and specialized data. Today we have two presenters from our StarMine research team. These data scientists have built a variety of models ranging from alpha-seeking models, from analyst revision to valuation models to short interest models, and then a combined alpha model. And they've also created credit risk models, predicting the credit default probability using different techniques. There are three models. One is a structural model. It's a derivative of the Merton model. There's a text mining model using the text feeds that I described before. And there's a smart ratio model, which is the evolved version of a Altman Z-score. And then they have a combined model, as well as a sovereign model for predicting the credit default of a sovereign risk. The topic today is predicting M&A activity, and it's actually very timely. This chart shows the level of M&A activity going back a couple of years compared to the interest in news, the readership in various news articles, ranging from the articles on divestitures, M&A, rumors of M&A. And what you could see in the most recent months is starting in March, April, and into May, there was an increase in readership of these articles, followed by an increase in M&A activity. This shows the association between news and actual activities, and is one of the reasons why we think it's really timely to review the new model devised by our StarMine team. And with that, I'm going to pass it on to our two data scientists from our StarMine team. First, Nelson Chin, who will be followed by Brenda Zhang. Nelson, let me pass it to you.
Thanks, Rich. This is Nelson Chin from Refinitiv StarMine Quant Research Team. Thanks a lot for joining us today for an overview of how StarMine applied deep learning to predict M&A activity. Let's start with a very brief introduction to StarMine. StarMine started in 1998 by ranking sell-side analyst accuracy. And over the years, our researchers have built out a full suite of alpha-generating stock selection models, credit default prediction models, as well as other predictive analytics. For example, smart estimates and analyst revisions model are our best-known offerings. And our combined alpha model and combined credit risk model are prominently displayed when clients look up any security in Icon, which is our flagship desktop product. MarketPsych Media Sentiment is the first model created as a partnership with another organization and lays the foundation for future partner-driven models, especially in the alternative data space. M&A arbitrage spread is our latest offering that tracks the spread between the offer price and market price of a company throughout the life of a pending M&A transaction, taking into account complexities around mixed offers of stock and cash, ethics, and dividends. M&A prediction will be next in line to build out our suite of M&A analytics. M&A prediction is an active research project, and we are currently seeking feedback from external clients with a target launch in 2021. It covers a global universe of public companies and predicts the likelihood of a company becoming an M&A target within the next 12 months. We are predicting M&A targets for 3 specific types of M&A events: merger, acquisition of majority interest, and acquisition of remaining interests. There are many possible use cases, including the generation of deal origination ideas for investment banking clients and the generation of excess return for investing and advisory clients. Here's a very high-level overview of the M&A prediction model that leverages the breadth and depth of Refinitiv's point-in-time data. Our model consists of a fundamental component and a text component. In the fundamental component, we perform fundamental analysis using M&A data, which also includes poison pill and proxy fight, data stream pricing, Refinitiv company fundamentals, and other structured data. We also make use of our own StarMine quant models as factors, and the probability of default from combined credit risk model is one example. In the text component, we perform text mining on Reuters news currently, and in the future, we consider adding other textual contents like street event transcripts, textual filings, and broker research. We combine the 2 components to create a 1 to 100 target likelihood rank to help identify potential M&A targets, covering the global public equity universe. We plan to highlight the M&A target likelihood ranks and supporting key factors in a new StarMine M&A deal prediction view in Icon and Refinitiv Workspace desktop products, with new filters available in the existing Screener app to generate lists of potential M&A targets. There are many benefits of combining fundamental and text in M&A prediction. The inclusion of unstructured data differentiates our offering from the existing workflow of many clients, which is 100% based on fundamental. While fundamental data are updated at most quarterly, many unstructured data are faster moving, which helps us to make more timely updates to our predictions. This is particularly true for Reuters News that covers breaking news 24/7. Another major benefit is the increased coverage universe of the overall model due to the orthogonality of structured and unstructured data. Our research reveals that a model combining fundamental and text performs better than a fundamental-only or text-only model. We split our data into a training set, a testing set, and a holdout set. Our training set includes data from 2003 to 2011, and our testing set includes data from 2013 to 2016. Year 2012 is intentionally excluded from the training set and testing set to ensure there is no look-ahead bias. We are holding out data from 2017 onwards for validation after we finalize our model. We employ the likelihood ratio as our main performance metric to evaluate our model performance. It is a measurement of how many more deals are observed in the top 10% of our model ranks than in the bottom 10% of our model ranks. In other words, it measures how many more times the top decile companies are acquired compared to the bottom decile companies. Our goal is to maximize the likelihood ratio of our model. Here's a chart of M&A events frequency by decile for the overall model. We divide all companies into 10 buckets by their M&A target likelihood ranks. Bucket 10 includes companies with highest ranks, and bucket 1 includes companies with lowest ranks. It shows a monotonic trend with companies in the buckets with higher ranks clearly tend to have a higher acquisition frequency. The likelihood ratio of the overall model currently stands at 9.17, indicating that companies assigned top decile M&A target likelihood rank is 9.17 times more likely than the bottom decile companies to be acquired in the next 12 months. In order for a company to receive an overall target likelihood rank, at least one of the two component ranks must be available. On the left-hand side, we summarize the average coverage of the testing set. Coverage of the text component is over 19,000 companies, and coverage of the fundamental component is over 22,000 companies. But the overall coverage universe is over 29,000 companies. On the right-hand side, we break down the companies by sector. The performance of the overall model is best for healthcare, industrials, technology, and consumer cyclicals. The likelihood ratios vary a lot by sector, and we are still investigating the reasons behind this. Some possible explanations include the fact that M&A activities come in cycles that are sector-specific, differences in valuation metrics across different sectors, and the rationale behind making deals in specific sectors. Let's zoom in to the text component. We have a binary text classification problem in hand, and our goal is to classify each Reuters news article as relevant to M&A events or not. We label a news article to 1 if it is dated within 12 months prior to M&A announcement date, and 0 otherwise. There are quite a few challenges in the labeling of news corpus. We want to only include news articles that cover company news and corporate events. In addition, we want to use the first tick of each news article and ignore any subsequent updates made days or even weeks afterwards. Fortunately, the machine-readable news feed from Refinitiv provide news topic codes and other metadata that greatly simplify the filtering. Another hassle is to map historical RICs. RIC stands for Reuters Instrument Code, which is a quote level identifier, to the correct companies, and we use symbology concordance in Refinitiv QA Direct to tackle this. On top of that, many news articles talk about more than one company, so it is important to attribute subsections of each news article to the correct companies. Before we get to the more sophisticated deep learning-based models, we first built a baseline model using a traditional machine learning method, which is more interpretable, and see what performance we can get using a simpler model. We brainstormed a list of deal-related terms and fed them into a semantic synonym generator to produce 165 deal-related n-grams. An n-gram means a sequence of n-words. We then used the list of human-curated n-grams to train a naive Bayes model, which is essentially counting words. Unfortunately, predictions from the baseline model are not better than random, so we have to look for more sophisticated models. We first investigated recurrent neural networks, or RNN, which is a pretty standard choice for text analysis. It handily beats the baseline model, but it takes longer to train. We then looked into convolutional neural networks, or CNN, which were originally developed for computer vision tasks, but later made their way in various natural language processing applications. Based on our experiments, training with CNN is 10 times faster than RNN, and predictions using CNN are more accurate than RNN. We also tried bidirectional encoder representations from transformers, or BERT, from Google, which is an application of transfer learning where pre-trained models are reused as starting point across different natural language processing tasks. Both CNN and BERT perform reasonably well in predicting future M&A events. We apply additional pre-processing to the news articles to avoid overfitting our model. We replace entity names with placeholders in news articles. As an example, we replace all company names with ORG in news articles. We also remove RICs in news articles and drop news articles with less than a certain number of words. Recently, we further improved performance of our model with BERT-RNA, which is a domain-specific BERT variant from Refinitiv Labs. BERT-RNA is an application of domain adaptation with further language pre-training using large amounts of in-domain data from business and financial news. It addresses differences in word distribution between the general corpora, typically used to pre-train language models, and the financial corpora, which often exhibit specialized language and symbology. Here's one specific example for Rentech nitrogen partners. The line in green shows the movement of the 1 to 100 text mining M&A target rank, and the vertical line in purple denotes the M&A announcement date. Our text mining M&A target rank for Rentech spiked from 40 all the way to 90 in October 2014, over 9 months before CVR Partners announced to acquire Rentech for $533 million on August 10, 2015. We performed a qualitative analysis by reviewing news articles covering Rentech before the M&A announcement date. Our analysis revealed major management changes at Rentech, with the resignation of Chief Executive Officer in December 2014, closely followed by the departure of Chief Operating Officer in January 2015. On February 17, 2015, Rentech announced it was exploring strategic alternatives and retained Morgan Stanley as its financial advisor to assist with the strategic review process. Here's a sample of research ideas that are under consideration. On top of the addition of other unstructured contents like transcripts, filings, and broker research, we are also considering the addition of private companies in our coverage universe and the expansion to include non-English documents. There are also a few areas that we can further improve on, including the accuracy of named entity recognition used to replace entity names, the algorithm that assigns different sections of news articles to respective companies, and the algorithm that aggregates document-level scores to company-level scores. One important piece of research we recently completed is concerning the interpretability of deep learning models. And I'm going to hand over to Brenda, who is going to cover the details.
All right, thank you, Nelson. Hello, everyone. Thank you all for joining this session with me. My name is Brenda Zhang. I'm on the StarMine Quant research team. As Nelson has just introduced, we have built a model combining text mining and fundamental analysis to predict future M&A events. Unlike other StarMine models, which are all clear box models, this M&A text model is a black box model. It's very important to explain how our model generates predictions and what part of the text would drive the model prediction. I'm going to share how we have approached to and what we have learned from using a method called LINE to explain this text classification model. We have studied different techniques to build the text mining component of the M&A prediction model, including CNN and BERT. Both are black box approaches. They don't start with the intuitive phrases that humans find relevant to M&A events, but instead, they learn by themselves. If we look at the two examples on the right-hand side, both are getting very high model scores over 90. The text in the front is the same as the one showed in Nelson's talk, where the company hired Morgan Stanley to help them with their strategic review process, and the board of directors agreed to seek strategic alternatives. As a human knowing about the financial industry, I can tell from the text that since the company is doing strategic review and they are considering strategic alternatives, they are highly possible to be acquired in a short term. But how does our model generate this score of 90? What part of the text contributes to the prediction? It's not clear. And we cannot find out the answer by just sharing the overall performance of the model. Without any model level or instance level explanations, customers might not understand the model or trust the model predictions. The challenge of explaining complex models has gained a lot of attention in the past few years. The industry is coming to see the need for more transparent models. We also think being able to interpret complex models is highly valuable and will be beneficial for both our customers and ourselves. It will provide more information to our customers over the model without sharing any detail on the inner structure of the model and help gain more confidence on the model performance in real scenarios. In the meantime, it will provide human-computer collaboration for our internal process to detect critical failures and biases like overfitting or biases towards protected variables, and eventually it will help improve the model. Several methodologies have been proposed in recent years to interpret complex models. There are two main categories. The first category is the perturbation-based methods. These methods are mostly model independent. They simply change the weights and variable values for the input samples to evaluate their impact on the predictions and draw inference in the process. They are relatively simple and provide human-friendly explanations, and they are quite flexible and can be implemented with any type of model. This category includes the line method and the chef method. The line method trains a local surrogate model on the samples with variations and calculates the coefficients to understand individual model predictions. The chef method computes the Shapley values inspired by game theory and uses that to explain the individual predictions as well as the global behavior of the model. The second category is the gradient-based method. These type of methods compute which features are important to a neural network depending on the weights and architecture of the model. They normally run a single forward and backward path through the network and compute the gradient of loss to be the contribution of the features. They are faster, but would require the inner structure of the model to be known before doing any type of analysis. There are many examples in this category. Layer-wise relevance propagation is one example. The method is computed with a backward path. The process starts with the final output layer and assigns relevance scores layer by layer till it gets to the input layer. In our study, we choose the perturbation-based method LINE to explain the M&A text model. Now I'm going to talk about what is line and how we implement line for the M&A prediction model. Line is a model-induced method, meaning that it can be implemented to any type of model. The method explains the model by incorporating variations to the input samples and understand how the predictions will change. The process starts with selecting one sample you have interest on, and then permutes the sample n times by tweaking the feature values and cause the complex model to generate predictions for all these permutations. It will then weight all these samples by their similarities to the original sample and fit a local surrogate model to calculate the feature importance weight. These importance weights can be used to understand the prediction on this sample. The top features and importance weights provided by line are mostly intuitive and human-friendly. The line method is also quite flexible and can be implemented to interpret different models and handle both structured and unstructured content sets. That's why we choose line for our M&A text model. As we have been studying both CNN and BERT, line will be super helpful as we haven't finalized the technique or formulation. There are definitely some shortcomings for line. One is that it can be unstable sometimes, and it can be computational heavy because line has to make thousands of calls to the complex model for all the permutations. If running the complex model is very time consuming, running line will also be very slow. We implement line to highlight the tags that drive the prediction of the M&A text model so we could provide more transparency on the model and detect potential failures like overfitting in the model. We first customize the line code specifically for this M&A text model and make it more flexible to handle word level and sentence level analysis. The method starts with a sample text and generates 5,000 permutations around sample. We set the number of important features to be 10 and a threshold of importance weights as 0.05. It means that we will only highlight the features with importance weights larger than 0.05. We also incorporate the transformation between the text pre-processed for model training and the original document. In the end, we would run the line method several times for each sample to make sure the importance weights are stable. This is an example showing how we use line to explain the model prediction. Our M&A text model predicts that this company protection one is very likely to be acquired based on the document on the right-hand side. The predicted likelihood is 0.94, as shown in the left section. In the middle section, we use line to generate the top features that drive the model prediction on this company. Features like strategic, bidders, alternatives, and bids are the most important ones for this model score. The numbers below them are their importance weights. In the paragraph on the right-hand side, we highlight these features based on their importance weights. The more important, the darker the color is. With this kind of highlighting, we provide some level of transparency on what drives the model predictions and why the model generates such a prediction. We followed a quantitative approach to evaluate whether line is able to identify important features for the text model. We start with the positive samples with correct predictions. We then drop the features from the text based on their importance weights generated by line and calculate the model performance on the updated text. We will start with the most important feature and followed by the second most important one. The benchmark randomly drops text from the document. In the chart here, the blue line is the line performance curve and the orange line is the random accuracy curve. Both curves start with a value of 1.0 because all sample predictions provide correct labels. As we can see from this chart, the line curve drops significantly faster than the random curve. This means that the important features identified by line are indeed important and relevant to how the model constructs predictions. If we take all 9 of them out from the documents, the model performance will drop from 1.0 to be similar to random guess. On the other hand, if we follow a random selection, the model performance will remain almost the same. We not only highlight the text for local predictions, but we also implement line to get insight on what are the important features for the global model. The table on the left shows some of the frequently highlighted features. Most of them, like bankruptcy, default, struggling, are intuitive and should be considered when we determine whether a company is going to be acquired. The figure on the right shows some other cases. We consider this as a qualitative approach to validate our model. We can see that some country names like Japan and Malaysia and some location names like Madrid are playing important roles in the model prediction. With this information, we learned that our model may overfit the training set on location names and might be biased towards certain locations. This qualitative approach helps figure out this critical problem and finally helps improve our model to avoid such bias. We also run some other studies to evaluate whether the importance weights line generates are stable. Given that sometimes the top 10 features line generates are not always the same, we calculate the minimum number of calls to get a superset of important variables. The left chart here shows that for most samples, we only need less than 5 rounds to get a superset of important features, although few cases would require up to 30 rounds. Our approach of setting a minimum value for importance weights to be included would also help make the weights more stable. Besides the superset, we calculate 2 indexes. One is the coefficient stability index. It evaluates how stable the feature important weights are. The higher index value guarantees that the important weights are more reliable. The other index is the sign stability index. It evaluates whether the signs of the importance weights are stable. And indeed, the right chart shows that almost all rounds are generating consistent signs of importance weights. So it's not likely to see features like default get a positive 0.4 in one round, but get a weight below 0 in another round. We have leveraged the line method to explain the M&A text model. The method provides information on how the input variables will influence the model predictions and provide more transparency on how our text predictions are constructed. The line method is definitely not perfect. We have studied different ways to improve the method, and we plan to do further studies to improve the implementation of line and make it more efficient and robust. We also plan to consider some other methods such as the anchors line method proposed by the same group 2 years ago, and some gradient-based methods to further enhance our power to explain complex models. Of course, in the meantime, we will continue our study in this area, not only for the M&A text model, but also for future black box StarMine models. That's all I have. Thank you all for your time. Please let me know if you have any question. I'm happy to take any question on this topic. Now I will pass the control over back to Rich.
Thank you, Brenda, and thank you, Nelson. So we do have some questions. The first question is, can we talk more about the pre-processing to prevent overfitting. Nelson, I think this really pertains to you.
Thanks for the question. This is absolutely a great question. So our main approach is to use Lime to, get some insight into the black box model. So we viewed the keywords highlighted by Lime. Those are the keywords that actually drive our prediction. And then we viewed, many samples of news articles. And so something that really jumps out is, so it looks like a lot of company names and location names, they show up as being important. So I think, so that actually gives us some idea, why a mention of United States would justify for a higher M&A prediction, right? So so that's give us the idea to say, if we we move the company names and location names, we replace it with some placeholder, and then that's one of the many pre-processing that we did to our news corpus, and absolutely on top of that, so we also, similar to many other, deep learning problems, so we also need to fine-tune the hyperparameters like the number of epoch and the learning rate. So these two in particular also help us to minimize our overfitting. So I think that's pretty much So if you have more questions related to this, so I'm happy to answer them offline as well.
Thank you, Nelson. There was one question with regards to the timing that this model will become available. This is really recent research. The research is now being put into production, and it should be available towards the end of the year, early next year, as a model that we'll be obviously making available to our clients. There's another question. How much did model performance improve after adding text component? Well, I think that's you, Nelson, but the model is a text model. But Nelson, why don't you address it?
Sure. So I think it's as part of the presentation. So there are two main components. So one is the text component, and then so we do have another component based on fundamental. So in terms of, if we look into the components separately, so the likelihood ratio of the fundamental component is actually higher compared to the text component. But one clear observation we have is by blending the fundamental and text, so we actually get better. We actually improve the overall performance of the model. But I think in terms of the magnitude of the improvement, so the overall likelihood ratio I think currently is around 9.17. And the likelihood ratio of the individual components. So for the fundamental component, based on my memory, the latest should be I think it's around 8.7, and then the our likelihood ratio for the text component is I think it's roughly 5.8. So I think that's sort of the breakdown. But I think the key is by blending both components. So we actually see improvement because they sort of complement each other.
Right. And we see that with other research being done with regards to combining fundamental data and text data. For example, our earnings surprise model, the impact on stocks is improved when you want to combine an earnings surprise model with the news sentiment at the time of the earnings announcement. There's another question here. How heavy are the line process for your case? Can you give us more specific indication of the time PC consuming of the model?
Yeah, sure. So for our testing, one example will take about 15 seconds to run for now, but we are continue working on this, try to improve the efficiency, and hoping that we can make it shorter when we deploy to production.
Thank you, Brenda. There's another question. In the future, do you see any possibility of using GPT-3, which, to be honest, I don't even know what that is?
Yeah, so I think, yeah, so we are absolutely open. I mean, because it is such a, I mean, NLP space is so fast moving, and I mean, there's many, I mean, innovation happening. So I think, so right now, I think, I mean, we look into BERT, and I think, yeah, so we I mean, it's sort of state of the art. I mean, but it is as of but it's sort of open source by Google in late 2018. I mean, there are, I mean, GPT-3, obviously, and there are other approaches that we are open to, I mean, explore. So, yeah, but just a little bit about the future. I think so we do have planned to, I mean, retrain the model once the model go live, and so we also consider the possibility of, I mean, so if the model, assuming the first release it would be based on BERT, then I mean the future, yeah, so we are not limiting ourselves to BERT or any specific, yeah, so GPT-3 is obviously in our radar.
And as you said in your presentation, we'll be looking at other sources of textual data to improve the information, the signal.
Yeah, absolutely. Yeah, so I think it's more, yeah, so it's on both fronts. I mean, so with more unstructured data that will help improve performance, but also, I mean, we get the cutting edge in the NLP community.
Great. So there were no more questions. In closing up, I want to first of all thank everybody for attending. Please do complete the pop-up survey before logging off. We do want to incorporate any feedback that you have on how to make these more useful going forward and what you liked and thought could be improved. And as Renee said, we will make the recording and studies available. They'll be shared with you over the next day or so. Thank you, everybody, for your participation today. Thank you, Brenda, and thank you, Nelson, and thank you, Renee.